Today I'm going to explain everything you need to know about ICT's silver bullet, but it doesn't stop there. I'm also going to give you a full strategy. I don't want to keep you guys here too long, so let's dive right into it. So what is the silver bullet? The silver bullet is basically a specific time where optimal trades form. So it's sort of like the London kill zone and New York kill zone videos that I've done, except this is a more specific time and higher probability trades can occur at this time. So essentially, if you've seen my previous videos, you know that we're looking for a break in market structure and then we're looking for some sort of fair value gap. Now, the only difference in this is that the fair value gap and break in market structure that we're looking at is going to form at a specific time. This break of structure right there is going to happen at a specific time, and that time is 3 to 4 a.m. New York time. You can see my artistic skills right here. But essentially, we're just narrowing it down even more. So the London kill zone before was 2 a.m. to 5 a.m. and now we're just narrowing it down with this silver bullet strategy, and it's 3 to 4. So if your break in market structure happens at 3 to 4 and that fair value gap forms between those times, then you've essentially got a higher probability trade on your hands. That basically just overviews what the silver bullet is. However, I'm going to give you a strategy as well, which you can go and implement right now on your chart. These are the 3 time frames we're going to be using, and then this is the time frame we're going to be using for entries. Obviously, you can change it for however you like. Instead of the 5 minute, you could use the 4 minute or the 2 minute, whatever. For the strategy on the daily, all we're going to be looking for is a daily bias. So the way I look at it is I look at market structure. Are we making higher highs or are we making lower lows? Whatever we're doing, that is going to be my daily bias for that day. So if we've broken this swing high right there, then I'm going to keep buying and buying until we break a swing low. If we break this swing low, I'm going to keep selling and selling until we break this swing high. Target today is 10 likes, so if this video is helping you out so far, then make sure to smash it. Thank you guys so much. The way I distinguish between a swing high and a swing low is that a swing high should have a lower high to the left of it and a lower high to the right of it. Same thing with a swing low. A swing low should have a higher low to the right of it and a higher low to the left of it. So let's just look at that right now. This is a live market. So if we look at this example right here, this is a swing low. Why? Because this is a low. It's got a higher low to the left of it right there and a higher low to the right of it right there. Same thing here. Another swing low. So it's got a higher low to the right of it and a higher low to the left of it. If we look at a swing high, as we can see there, one there, a lower high to the left of it and a lower high to the right of it. Same thing there. So you can go on your chart and just mark out these swing points, and then once they break, then you can say that there's a shift in market structure and you can change your daily bias. Now on the hour time frame, all we're going to be doing is looking for fair value gaps. So let's say this is the hour chart. All we're going to be doing is marking out fair value gaps here. So if there's a fair value gap, then this is a potential for price to trade into during this time of 2 a.m. to 5 a.m. and more specifically 3 a.m. to 4 a.m. So we're going to look for price to enter this fair value gap, and then we could look for a trade. Similarly, if we're bullish, we're going to be looking for fair value gaps on the hourly chart somewhere there or there, wherever they form, and we're going to be looking for price to come into this fair value gaps, these areas of interest. So check out my power of confluences video, because I really stress how important having more and more criteria is into making a trade more high probability. We're going to be looking for price to tap into these areas of interest during our times, and then we're going to be looking for a continuation. On the 15 minute, it's pretty much the same. We're just going to be looking for fair value gaps on the 15 and price to trade into it and then go down. So I could basically just copy this. Okay, it's not going to copy. Yeah, I could just do that. So we're looking for the same thing on the 15 minute, and in the same way when it's reversed, same thing. Now on the 5 minute, if you've seen my videos before, you know that there's pretty much one best way to enter, which is once we hit our time of 2 a.m. or 3 a.m, all we're going to be looking for is a swing low to form, a sweep of that right there, because this is a high which has liquidity on top. We're going to see a sweep of that, and then we see a break of market structure right there, a fair value gap to form. If it doesn't, we don't take the trade. If it does, we take a trade, price goes back and it continues. This is idealistic. Obviously, you're not going to win every trade, but this is the entry model in short. There, break in market structure right there, and then fair value gap to form here, and we trade that, take it down. So let me just recap where the silver bullet comes in. So we're only going to be trading, if you're a London trader, from 2 a.m. to 5 a.m. But the silver bullet comes in at this point, right? If this break of market structure, this line, if price goes and breaks it at 3 a.m, right? 3 a.m was the main thing. So if I take this there, here, at 3 a.m to 4 a.m. If the break of market structure happens at this time, then we've essentially got a silver bullet, which basically just means a higher chance of the trade playing out, but obviously it doesn't have to. It's just a higher chance, a higher probability. I'm going to show you a quick example of this entry model and basically the whole strategy as a whole. So let's say we're bearish on this day. All we're going to be looking for is at 2 a.m. we're going to start looking for entries, and if at 3 a.m. an entry happens, or 3 to 4, then it's essentially higher probability and it marks the criteria of the silver bullet. So right now, as you can see, it's 2:28. So the London session has started, and a major criteria I need is a sweep. So I need this high to get broken, otherwise I'm not even interested. So as you can see, it gets taken out right there, liquidity sweep, and we have these fair value gaps. This is one which we've tapped into, and this is another one which we could potentially tap into. These are all 15-minute fair value gaps, so it marks the criteria of the strategy as well. Now I'm going to get my break of market structure line. So as I said before, I'm looking for a swing low to be broken. So as you can see, this is a swing low, right? So this was the break in market, not really break, but this was a liquidity sweep. So if we work backwards, this was the most recent swing low. So I'll draw my line there. As you can see, I'm entering on the 4-minute right now. You can switch to the 5-minute too, but let's see on the 4-minute what happens. Okay, we have another swing low right there. If I can zoom in, it's easier to see. So as you can see, high low to the left, to the right, high low to the left. So this is my new break of market structure line, and it's still 2:48. So we're not actually at the silver bullet time. And as you can see there, we have a break of market structure. It's with a wick, so probably a more valid trade. However, yeah, 2:56 if happens, and then we have no fair value gap still, so no trade. Okay, we go up again. Then our new swing low is right there. And as you can see, we've almost tapped into this fair value gap. And there we go. Body break, so it's showing momentum. It happens at 3:32, so marks the criteria of the silver bullet. So essentially we have a silver bullet, right? We've tapped into a fair value gap, almost tapped into this, or we probably have tapped into that. A really small fair value gap there. Put your entry right there, stops wherever, ideally above there, but 4 pips is really small, so go for a 7 pip. And then yeah, wait to be tagged in, which it does there. And then yeah, essentially, since our bias is bearish, that's why the high time frame is so important, because if my daily time frame was telling me I was bearish, so I'm only going to be looking for shorts. If you automatically just go on the 4-minute time frame, you're going to get lost in all the noise. So it's always good to have a high time frame narrative before you trade. So my high time frame narrative was bearish, hence why I'm looking for shorts. Silver bullet marks the criteria, simple 1 to 2, easily hit in what, 8 minutes. So 8 minutes, 2%, or however much you risk. And yeah, that's pretty much the strategy. Nothing complicated, which is how it should be. Nice and simple. So that wraps up another video. I'll see you guys next week. Stay safe and happy trading.